When comparing investments, we usually look at returns. But taxes can change what you actually earn. That matters when comparing fixed deposits, equities, and real estate investment trusts or REITs. So how are these investments taxed and how much do you actually get to keep? Let's understand. Fixed deposits are simple to understand, but the tax treatment can reduce your final return. The interest you earn on an FD is generally taxed at your applicable income tax slab rate. Banks deduct tax deducted at source or TDS when the annual FD interest crosses the specified threshold. The standard TDS rate is 10%. It can rise to 20% if you have not provided your permanent account number or PAN. But TDS is not your final tax bill. It is tax already deducted on your behalf and adjusted against your final tax liability. So if your FD earns 7% and you are in the 30% tax bracket, your effective post-tax return would be around 4.9%. And if your final tax liability is higher than the TDS already deducted, you may have to pay the difference while filing your income tax return. And what about equities? For qualifying listed equities, the tax depends on how long you hold the investment. If you sell within 12 months, the gain is usually treated as short-term capital gain. Such gains are generally taxed at 20% subject to applicable conditions. If you hold the investment for more than 12 months, qualifying gains are treated as long-term capital gains. Long-term gains above 1.25 lakh rupees are generally taxed at 12.5%. So for qualifying listed equities, the longer holding period can get more favorable capital gains tax treatment. Now let's look at real estate investment trusts or REITs. REITs own and manage income-generating real estate on behalf of investors. Their payouts can include different components such as interest, dividends, and repayment of debt. Each component has a different tax treatment. The REIT distribution statement shows what each part of the payout represents. This is where the proposed tax change becomes important. It targets one specific component, dividend income. The Taxation and Other Laws Amendment Bill 2026 proposes to change how the dividend component of REIT and infrastructure investment trusts or InvIT distributions is taxed. Under current rules, this dividend is exempt when the underlying special purpose vehicle or SPV follows the old corporate tax regime. An SPV is a company set up to hold and manage a specific asset for the REIT. But if the SPV opts for the new concessional tax regime, the dividend can become taxable at the investor's applicable slab rate. The proposed amendment seeks to remove this condition. This means REIT and InvIT dividends could remain exempt regardless of the SPV's tax regime. For example, an investor in the 30% tax bracket receiving 75,000 rupees in REIT dividends could currently pay around 23,400 rupees in tax, including cess, if the SPV has opted for the new regime. But if the bill becomes law, that tax could fall to zero. However, this does not make the entire REIT or InvIT distribution tax-free. Only the dividend component would get the exemption. Interest and other taxable components would still be taxed separately. Until the bill becomes law, existing tax rules continue to apply. So which one is more tax efficient? There is no single answer. An FD offers predictability, but interest is taxed at your slab rate. Equities can offer more favorable tax rates on qualifying long-term gains. REITs can provide regular income, but their tax treatment depends on the nature of each payout component. That's why investors should look beyond the headline return. The number that really matters is your post-tax return. Follow Business Standard for more such personal finance explainers.